The bulls and the bears have been fighting for months. On this macroeconomic update, we look at the question, does the bull have the bear under control? The press would have you think that the bear is under control and the banking crisis has been contained. I mean, that's the way it feels, right? Well, it's never different this time. But right now it sure feels like it is. I think we're in the most complex and challenging macroeconomic environment of my lifetime. And because of that, it's important to stay open to all possibilities. This is a very risky time, but all profit is derived from risk. So many people are going to make tons of money if they can make the right plays in this market. A lot's happened since the last update. So let's look at some highlights. We had the second biggest bank failure in the United States history. The Federal Reserve, they brought a 25 basis point interest rate hike. And the S&P, it surged 3% during March in the face of all of this. So with that in mind, let's look at the case for the bulls. The bulls point to things like the fact that the U.S. has never had a recession begin with real interest rates deeply negative across the yield curve, as we have right now. And they also point out that the labor market is too strong for a recession. And finally, they also mention that the 20-month moving average, it has support indicating a new bull market. I don't think that's the case here, and I'll give you a little bit more info on that in a minute. I do think that we will see the bear trap momentum-based rally continue in April. As we can see in this chart, April is historically a great month for returns in the S&P 500. Since 1950, the month of April, and pre-election years, it's seen gains 94% of the time. That's a really good track record. Why? Well, consumers usually start to come out of their post-Christmas spending pause in April and make some springtime buying. They get tax refunds and they run out and spend them. A lot of people go and buy used cars. And we're about to enter one of the best performing periods of the 4-year presidential election cycle. I've got this article from Markets Insider that notes historically the second quarter of a pre-election year, it's up a solid 4.8% on average, and it's higher 72% of the time over the whole time, not just going back to 1950, which is still pretty good. Before I move on to the bear side of the argument, I want to ask you to hit that like button if you enjoy this update, and hit the subscribe button if you want to know when the latest video drops. I spend many hours consolidating a lot of research down to just a few minutes to produce relevant, high-quality videos, and when you like the video, it helps others discover this content. So thanks for giving me a like. So now what about those bears? I think this is a bear trap because historically, we haven't been able to beat inflation without a recession. Demand destruction from raising interest rates and quantitative tightening are the only tools the Fed has to fight inflation. So let's take a look at quantitative tightening. With quantitative easing, the Federal Reserve buys assets, and with quantitative tightening, they sell them. So the Fed has resumed buying assets. They're back into quantitative easing. This chart shows that 64% of the 9 months of quantitative tightening that the Fed has done, it was wiped out in just 2 weeks because of the banking crisis. That QE looks a lot like the start of the 2008 cycle. At this time, based on the current information, I don't think this is a debt collapse cycle quite like 2008, at least not yet. Do you think the Fed can hold interest rates above 5% without causing a recession? I don't, because our economy has gotten too addicted to cheap money and low interest rates over the past 10 years. And believe it or not, this is good news because it means the Fed can start to wait out inflation in some parts of the economy. Mainly in goods and housing, but surely not energy and food. Energy is going to stay expensive. The Saudis had a warm discussion with Russia recently, and OPEC Plus just announced they're cutting production of oil through the end of the year. Meanwhile, Japan has just announced that it's going to cut with the allies and buy Russian oil above the cap price. Interesting geopolitical times for sure. So back to the ability of the Fed to wait out parts of inflation. This is great because the Fed, it can't raise interest rates much above 6% in current conditions without triggering the Triffin dilemma. What does that mean? Well, as the reserve currency of the world, there will eventually come a day when the Federal Reserve will face a choice of doing what is right for our domestic economy or what's best for the global economy. And there is no long-term right answer. That's why it's called a dilemma. There's been a massive spike in credit default swaps on the U.S. government, not companies, but the U.S. government. So investors, they're betting massively that the U.S. government is about to default on its debt. Probably because the debt ceiling fight is about to resume. It's looming out there, and we'll see what happens. At the same time, though, big money is betting that the S&P will fall. According to this article from Markets Insider, the commodity trading advisors currently have a $26 billion bet that the S&P will fall. This is the largest short position since around October of 2021. Let's go back and talk about inflation for just a minute. Goods inflation started to drop recently as consumer demand wanes for goods. And China has just come out of lockdown after 2 years. So the production side of China, it's ramped up, while the demand side, it's gone down. And we can see that in the chart here that shows that exports haven't spiked with production. This means that China will either have to start lowering prices or stop production. This is not a good sign for the Chinese economy. But back to our economy. Wharton's Jeremy Siegel, he says that the Fed's economic outlook is absurd and there's no way to lower inflation while simultaneously stabilizing the banking system. And I agree with him. After raising interest rates, the Fed lowered its economic growth forecast for this year to 0.4% from 0.5%. Given that the GDP now estimate from the Atlanta Federal Reserve looks rosy at 3% for quarter one, that would indicate the next 3 quarters of GDP will be negative, which means a double-dip recession. I say that because I think we had a recession last year, and Main Street knows it. But Wall Street doesn't see it that way because government spending on the war in Ukraine makes the numbers look better than they otherwise would be and helps move us over outside that technical recession. Remember in a previous update when I said that we'd have an earnings recession? Well, forward EPS growth has been negative for a while. And as we can see in this chart, that usually means that the S&P 500, it hasn't bottomed out yet. Layoffs are now being used to buffer against dropping profit margins, but that's a short-term solution at best. This is a complex environment, and so anything can happen, especially as things change in the geopolitical landscape. So tell me, do you think we've entered a new bull market like the moving average support indicates? Or do you think that the current rally is just a bear trap like I do? Tell me in the comments below what you think will happen next in the economic circus.